Details discussion of important points of Hindenburg Research report on Adani. Friday was the second distressing day for the self-made business mogul's empire on Dalal Street. Investors have altogether lost around rupees 4 lakh crore in a span of just 2 days. There are several reasons for fall, however major fear is due to Hindenburg Research report on Adani. Let's discuss who are Hindenburg Research releases. Hindenburg Research Releases is a US-based research team that offers services in forensic financial research, with a focus on equity, credit and derivatives analysis. Their fundamental research often includes studying and reporting on companies with accounting irregularities, unethical practices in business, related party transactions, bad management etc. Its primary method for investment is said to be short selling. Let's take a short glance on Adani Group. It is one of the largest group of companies in India which specializes in infrastructure projects in coal, ports, cement, green energy and even edible oil. It has made the news in India lately because of its rapid expansion in the cement industry, buying majority stake in Ambuja Cement and ACC Limited, as well as news media, buying around 30% shares of NDTV. Its owner, Mr. Gautam Adani, has been one of the top 4 richest persons in the world for some time now. The following is a list of a few of the major listed companies that come under the Adani Group, such as Adani Enterprises, Adani Ports and SEZ, Adani Green Energy, Adani Power, Adani Transmission, Adani Total Gas, Adani Wilmar, Ambuja Cement. Now let's discuss important key points in the Hindenburg Research report on Adani. The following are some of the claims made by Hindenburg Research on Adani Group. First is overvalued shares. The report cites data from FactSet and Hindenburg's own analysis to claim that the Adani shares are highly overvalued by conventional metrics such as P/A ratio, price, sales ratio and. Some of the extreme cases include the P/A ratio of Adani Enterprises being 42 times the industry average and the price/sales ratio of Adani Total Gas being 139.3 times the industry average of 1.0x etc. Second is debt-fueled business. 5 out of the 7 key listed companies mentioned have reported a current ratio of less than 1. This means that the total amount of current assets is less than the total amount of current liabilities in those companies. This is not a healthy financial practice, as this means that the companies are unlikely to have adequate assets to pay off their liabilities in the short run. Third is promoters pledging their stocks. This means that the promoters of the company have taken on additional debt on the basis of the shares that they own. As seen above, the share prices are claimed to be already high and so is the debt. Therefore, promoters pledging stocks to take on more debt is not a healthy financial practice in such a context. Fourth is doubts regarding the management team. The report claims that some members of the management have a questionable past, which includes allegations of fraud, duty evasions, scams etc. Fifth is excess promoter control of shares. It has been alleged that in addition to the already high proportion of promoter holding in shares, close to 74% in multiple cases, significant portions of the remaining public shares are also controlled by shell companies that have ties with the Adani Group. Many of these companies have a large majority of their shares invested solely in firms under the Adani Group. This may mean that in practical terms, those companies may have worked their way around the SEBI mandate that requires at least 25% of the shares of a listed company to be in public shareholding. This exposes these companies to a high risk of being delisted. Sixth is pumped up demand. The preceding point also hints at deliberate pumping of the Adani stock prices through excessive buying pressure from companies that seem to be biased towards, or perhaps connected with, the Adani Group itself. It is claimed that the delivery volume of Adani stocks may have been high because of possible wash trading, i.e., buying, selling of a share by the same or related entities to pump up the trading volume numbers. Rumors regarding the involvement of the noted stock manipulator Ketan Parekh have also been raised in the Hindenburg report. Last and seventh is inadequate compliance. The report claims that one of the firms hired to bookrun the Adani Green Energy has had past problems with the SEBI. Moreover, one of the independent auditors hired to audit Adani Enterprise and Adani Total Gas seems to be too small a company and comprising professionals too young to be able to handle the auditing of such a large array of companies. Now, what retail investors need to do? Retail investors may not need to worry about the entire Adani Group Hindenburg clash, as in the larger scheme of things, The Adani Group may be considered by some as a too big to fail entity. Allegations, legal suits come and go. But if as an investor you found the stock to be fundamentally strong or weak by your own metrics, then you may choose to stick with your decision. The best way forward is to independently analyze any new information on the fundamentals and price action and take an unbiased decision considering returns and timeline. Stay tuned. Bye bye. Happy trading. Like, share, subscribe.